here. Let's chat a little bit about Saurabh Mukherjea. Uh, is joining us right now from Marcellus Investment Managers to talk about exactly what Indian investors should be doing and not doing. Saurabh, hi, good morning. Good to have you on the show. Saurabh, for someone who actually maps India's consumption patterns so closely, what is it that your read through has been? Because it's really not been an across the board move when it comes to consumption. Rural is picking up, but is still patchy. Two wheelers are doing good, passenger vehicles are not, but premiumization continues to rule the roost.
So, Aisha, I think the first couple of years after COVID, we benefited from two different things. One was obviously revenge spending. People saved up in those 2 years of sitting at home during COVID, and when they came out of their houses from Diwali 21 to Diwali 23, the revenge spending piece played out. But also, what helped consumption in that aftermath of COVID was easy availability of credit. The RBI increased money supply to deal with COVID, and that made the system flush with cash, flush with money supply in the immediate aftermath of COVID. So, credit demand, consumer borrowing, personal loans, credit card, the whole piece took off. And we had three blazing years, I would say 22, 23, and the early part of 24, three blazing years for consumption. As we all know, government capex also added to the party atmosphere. That consumer borrowing piece, especially in urban India, as you're rightly saying, that piece I think is under pressure as we are seeing in the results of the banks and NBFCs, delinquencies are up, first check bounces are going up, even in affluent cities like Hyderabad and Bangalore. From what I'm seeing, first check bounces are going up. The IT job creation story is non-existent. And even amongst the bigger banks, my reading is even of the bigger banks are letting go of people. So the lack of job creation, the depletion of savings, very clear in RBI data, net household savings are at 50 lows. I think that's the driver of urban consumption being under the pump. You're right in saying the rural piece is recovering. The rural piece didn't take off as much after COVID, and therefore now that the post-COVID, the damage of COVID on rural India is gone. The rural piece seems to be showing signs of life, and now we are optimistic that a good monsoon will give further fillip to rural consumption.
So, how do you maneuver this dwindling consumption pattern right now, Saurabh? And as an investor, how do you now approach the entire basket? Because it's going to have a multiplier effect, the reasons that you just highlighted.
So there are, I think, three things that we are trying to do, and let's quickly highlight them. The first piece is if you want a place to play the highest end of the most highest quality end of Indian consumption, then I would say look at the two best private sector banks. They seem to be HDFC Bank and ICICI Bank. We have both in various portfolios. Their asset quality is holding up. Their liability piece is stronger than ever before. And I suspect again that once again the public sector banks are going to fall behind. But it's interesting this time, barring HDFC and ICICI, the rest of the private sector banks also look to be struggling on both sides of the balance sheet. This is very interesting. Both sides of the balance sheet, we're seeing the private sector banks having a challenge. So the best of Indian consumption, in a way, the best of Indian retail, I think has been locked in by these two premier private sector banks. The second piece is, as is always the case in an economic downturn, the pharma healthcare piece holds up. And the good thing about India now, it's no longer just pharma. Hospitals, diagnostics, those are good places to be. The rise of Medicare, the rise of medical insurance, the government doing Ayushman Bharat has created a big and fast growing private sector hospital diagnostics ecosystem. I think that there's money to be made by deploying funds there. There's obviously valuation issues, but there are still attractively valued plays there. And the third piece that we're doing is we're going abroad, right? So we're investing significant sums of our own money and encouraging clients to join us in investing in European and American small and mid cap companies, which are available at half the valuations prevalent in India and for double the earnings growth. For example, in America, household debt is at 25-year lows, and the consumption piece is holding up nicely, and valuations there are half of what we are getting here for double the earnings growth.
Interesting you say that. So, sort of, where are the new opportunities? Considering you so closely look at consumption as the theme, where is it that you're still finding that valuation comfort?
So the healthcare piece, I think it's actually very exciting. I think we are at the beginning of the healthcare story. neither the state government nor the central government is adding meaningfully to the hospital beds piece in India. And naturally, with the population growing at 2%, with growing desire of the middle class to be treated well, yeah, I think we will see the private hospital sector grow leaps and bounds. We've been long-standing shareholders now in Narayan Hridayalaya. It's in many of our portfolios, but there are other smaller high quality hospital chains that we've owned in the past. We might own them in the future. So Rainbow Healthcare, which focuses on the maternity gynac piece, I think is a well-run company. But there are plenty of plays in hospitals, and I think more and more of these private hospital chains are going to go public. As is well known, every PE company, every PE investor in India is building a hospitals platform. Diagnostics has been a long source of wealth creation for our clients. So Dr. Lal Path Labs for many years has been a big part of our core portfolios. We also believe Vijaya Diagnostics in southern India is doing a good job. Through acquisition, they've grown in Pune and Kolkata. Southern India is now, I think, roughly twice as rich as the rest of India. And naturally, as in richer parts of the country, the desire for diagnostics and healthcare is greater. So path labs, hospitals, plenty to play for. Valuations are still in the realms of sanity rather than in the realms of fantasy.
All right. Hi, Saurabh. Morning. This is Shrishti joining in. But Saurabh, the key fact for the Indian markets remains that the domestic liquidity is very strong right now. We have just seen that SIP number once again hitting in. But one of the sectors that is likely to be beneficiary of this trend rather, which is already in the making, Saurabh, is actually the AMC space. What's your take on that? Because this liquidity driven movement is what we are already seeing in select sectors. But do you believe in order to be a beneficiary of this story in the stock markets, AMCs can be a good bet?
I would like to say that as a shareholder in my own AMC, I would like to say that. But I think I have to be realistic here. Given that some really big boys are entering the AMC space with lots of capital, many billions of dollars, I have a feeling that we are going to see profit margin compression in the years ahead. This is a classic capital cycle playing out where lots of AMCs are coming up and plenty of capital is coming in. So in our portfolios, coming back to our portfolios, we have sold out on our stock market plays, whether it's AMC, wealth management, the infrastructure which undergirds the stock market. So caution is a relevant part of investing, and looking at the juicy valuations in that space, we've sold out on the stock market related, the wealth management, asset management related plays in our portfolios.
Okay, so that's the take on that. With Saurabh, last time we interacted, we had just received the first sprint of tariffs on India, and now that situation has escalated so much, because right now temporarily, even though that may be the case, we're still at 50%. What's your outlook on what the impact could be on the markets if this number were to continue to be after above 25%, even after the meeting that we are all watching very closely?
My reading is much of this is negotiation and hardballing of India. The critical negotiation here, I think, as you're alluding to, is the Putin-Trump negotiation. Clearly, to my mind, the American president is putting pressure on Russia by punishing India for buying Russian oil. Hopefully the Putin-Trump negotiation ends up in something fruitful, whether it's Ukraine, whether it is some sort of broader deal between Russia and America. Once that piece is off the table, I think tariffs will come down. Once upon a time, I was hoping for 15. I think 15 looks unrealistic. I think a 20 type tariff on India, 20% on India, and hopefully 30% on China. A 20% tariff on India and 30% on China, I think will be a decent outcome here. It'll give India an advantage vis-a-vis China. It'll give the China plus one plays a fillip. It'll allow America to reduce its dependence on China. So 20 on India, 30 on China seems to my mind to be the steady state that we'll end up, say, 4 or 5 months out, once the Putin-Trump negotiations reach some logical end.
Interesting. Saurabh, what about the new age tech piece? Because, I've been chatting with many market experts and everyone's sort of scratching their head to figure out what could be the next banks. Now, of course, it's going to take some time to reach that kind of weightage that banks cherish and share right now. but anywhere where you feel leadership can come about and at least can give banks a stiff competition in years to come, not today, not tomorrow.
So I think, Aisha, as you're alluding to, right, uh, in banking, the RBI does, in a way, a great job for the incumbents by blocking new entry. So I think AU Finance got the first universal bank license in 10 or 11 years. In, I think, 30 years, India has had three new universal banks. So, but the RBI blocks entry into banking, and that, in a way, makes the job of the incumbents slightly easier. But in broking, in asset management, there is no such blocking of entry. And I think the sweeping up of the broking asset management space on the back of tech, disruption of asset management and broking on the back of tech is upon us. We've seen the impact of firms like Zerodha, firms like Grow. The digitization of broking and asset management is reasonably easy to fathom. And even a small player like us, right? We haven't built a single branch, and yet we've been able to grow the business reasonably smoothly just by focusing on high net worth investors. So the broking tech asset management space, right? The use of fintech to drive broking and asset management, I think will be a big theme for the next decade. In any such construct where technology is being used, the big will get better, the big will get bigger, and therefore I think the smaller players, especially the players who do not have technology, I reckon will fall behind. So we'll see consolidation in broking and asset management driven by technology, and it'll be very interesting to see that the newer entrants into the AMC space, will they be able to use fintech to disrupt the space? We haven't seen much of this, interestingly, in America. And broking, we saw Robinhood do this in America. So in a way, Robinhood's counterpart here would be a Zerodha. But in American asset management, we haven't seen tech play a disruptive role in consolidating American asset management. It'll be interesting to see whether the new age Indian AMCs are able to do that. But broking seems relatively clear. To my mind, I think AMCs also will consolidate on the back of fintech.
Very interesting take. Saurabh, good chatting with you as always. Thanks for your time.
Thank you. Thank you, Isha.